For the markets, we're at the higher end of today's trading range, 10,820 thereabouts for the Nifty. And the last bit of up move for the markets could be attributed to the IT stocks. So the likes of Wipro, Tech Mahindra, Infosys, all of them at the high point of the day. Also, Hindustan Unilever has moved a little higher. As we speak, ITC is the one which is dragging the index, which is why it's mildly off the highs of the day. But no complaining as far as the market moves are concerned, primarily given the sort of rally that we've seen over the last day and a half, rather 2 days and a half. First up, all the top stories, and then we get to answering all your queries. Another day of gains on the Lal Street, in line with the Asian indices. Infosys, HDFC Bank and L&T add to the gains, while TCS, UPL, Sun Pharma and ITC are the key draggers. The mid-caps, they continue to outperform. Financials, the big gainers today. NBFCs and housing finance companies get a boost as bond yields fall, the rupee appreciates and inflation comes in at a 17-month low. Yes Bank comes off the highs of the day but still trades in the green as a crucial meet is underway. Sources tell cnbc TV18 that the Search and Selection Committee have discussed the final shortlist for the CEO in a meeting yesterday. Sun Pharma sulks. The stock is among the top Nifty losers today after the SEBI chief confirms that they've received a whistleblower complaint on the company. And with that, we go across to the mutual fund corner with Sumera and Manoj Nagpal.
Mangalam, thanks very much for that. You're right. Manoj Nagpal of Outlook Asia Capital joins in this afternoon as my guest. Hi, Manoj. Good afternoon to you. And, well, this whole issue of side pocketing in liquid funds looks like it's going to be a reality now. We finally caught up with everyone. But the final regulations are not yet out. So in the absence of them, any concerns from the point of view of the industry or the investors?
Well, the industry has been, strongly going to SEBI and asking for side pocketing, especially, funds like Tata Mutual Fund, BO, AXA Mutual Fund, which had shut down subscriptions and then later restarted subscriptions. They were very keen that side pocketing should be introduced quickly. One of the good things in side pocketing is that it isolates the asset which has turned bad, and SEBI is going to give some regulations around this. It's not going to keep it completely free for mutual funds to decide. It's only if there is a credit event, a default like this situation happens, only then a side pocket can happen. Globally, a side pocket can be created just at the discretion of the fund manager without any credit event happening. So there is one good safeguard that SEBI has put in this place.
Yeah, that's something that, even everybody wants to know, actually, that what are the conditions under which a mutual fund or, its trustees will be allowed to actually move that security into a side pocket. Besides that, Manoj, you think that this could be accompanied by any sort of rules regarding how the industry should actually start writing off bad assets?
Well, the writing of bad assets or assets which get downgraded. So it may not even turn an NPA. It may not kind of default completely. But if there is a downgrade of an asset also, currently the rules are fairly flexible, giving a lot of leeway to the fund manager and the accounting team to value assets differently. So the same asset in the current context could be valued differently in different schemes based on the perception or the accounting policies that each of the mutual fund follows. There is definitely a need at this point of time for SEBI to, put down these guidelines more strictly, so the same asset gets valued similarly, and even when an asset gets downgraded, how much is the write-off to be done is not left at the discretion of the accounting of the mutual fund. We have seen in the recent past that this happens quite often, that different people value and write down assets differently, which is not to the advantage or the benefit of the investor.
All right, so I hope somebody at SEBI is listening, that these are the two things that we really want to know. One is, of course, in absolute black and white, the regulations which would govern the side pocketing in mutual funds, and also, proper written down rules, ironclad rules as regards writing down of bad assets. All right, but let's get started with answering the queries that are coming in. Vini Deepak has written to us from Bengaluru. So he wants some advice on where to invest 5 lakh rupees. He's a long-term investor. She's a long-term investor. She hasn't actually told us how long she's looking to invest, but she's 38 years old. So I'm going to assume on her behalf that it's a minimum of 10 years.
10 years, yeah. So that's a good thing. So, from what the profile that you've told me, it looks like she's very keen to create wealth, and she is, willing to wait for the long haul, and she has the patience of at least 10 years plus. Now, when you're looking at 10 years plus, clearly equity funds, play the role of creating higher wealth creation. And within equity, for a person like a housewife who's just entering into mutual funds, I always suggest the way to go forward is using multi-cap funds. And within multi-cap funds, since she's a housewife, she should ideally choose funds which have low volatility, low beta, and funds which have lower volatility. That's to start off with. So I would suggest her a mix of 3 funds that she should look at, starting with the Parag Parikh long-term fund. It's managed by Rajiv Thakkar. And the reason we suggest is that it has a 25% international exposure, it plays along with the asset allocation across equity, is a deep value approach, has around 20-25 stocks in the portfolio, and the fund is impeccable. So Rajiv Thakkar has demonstrated that they stick to the investment philosophy. The second fund we say is the ICICI Multi-Cap Fund. ICICI Multi-Cap Fund is now managed by S. Naren. As we said, he is one of the best fund managers to navigate markets like this. And this is a fund size of around 3,000 crores and has stocks around 50-55 stocks in the portfolio, again with a deep value approach. So that's the second fund. And the third is the Kotak Contra Fund, managed by Deepak Gupta. He has been managing this fund for the last 10-12 years. And it's a fund, again, which is a deep value fund, but a lower volatility fund. So these are the combination of 3 funds I would suggest her to get started off with.
All right, up next, a query comes in from Mr. Gantar Prasad. In fact, he's on the line with us from Pune. Hi, Mr. Prasad. Good afternoon. How can we help you?
Yeah, hi, Sumera. Hi, Manoj.
Hi.
I have a fund of 50 lakhs, 50 to 75 lakhs. It's a one-time investment, and I'm looking for 3 to 5 years initially and can be extended to 10 years.
Okay.
And I'm expecting a return of 15 to 19%. And my last query is that, is there an insurance policy which is for my investment amount?
Okay, Manoj, quite a few questions, but nevertheless, I don't blame him because it's a large one-time investment that retail investors would make. So therefore, for a sum like that, you'd want insurance. But I mean, to my mind, I can't seem to recall anything that would fit this particular purpose.
Yeah, when you're investing in the equity markets, the only insurance that you can have is that you invest for the long term, have patience, and ignore the short-term volatilities. Apart from that, there is no formal instrument that is available from an institution for you to insure your portfolio to protect against any capital downgrade or capital going down. The key thing to remember is that equities over the last 20-25 years have given returns in the range of 20% plus. So, for example, exactly 25 years back, the Franklin India Blue Chip Fund was launched under the Kothari name, and the Franklin Prima was launched. So 2 funds were launched on 1st December 1993. They have now completed 25 years exactly. Both of them have given 20% plus returns in the last 25 years. And if you go the last 15, 20 years, so that's been the track record that equity has, given over the long-term mutual funds. However, it's not a simple thing that you can extrapolate this returns for the next 5, 10, 15, 20 years. You need to remember that the last 25 years was a totally different environment. India went through a liberalization, the inflation was very high, interest rates were very high. Currently, we are into a low inflation regime, low interest rate regime. Inflation for the foreseeable future will be in the range of 3 to 5%. Interest rates will be in the band of 7 to 8%. At that point of time, one should not expect a 15 to 20% return. It's not possible from equities to generate that kind of return over the long term. Given that your perspective is only 3 to 5 years, I would strongly recommend that you go in for the balanced fund category rather than going for equity funds. And if you're looking at equity funds, then go in for a large cap equity fund like a ICICI Blue Chip, which is a low volatility fund. So that are the 2 recommendations that I would give you. And ideally, don't try to insure the portfolio. Some of the people may give you an advice that you can insure it by doing futures and options and hedging your portfolios. I would always advise keep it simple, think long term, wait out the volatility, and your returns will be there in the range of 10 to 15%, not 15 to 20%.
All right, Mr. Prasad, I hope that advice works for you.
Yeah, thanks.
All right, thanks very much and all the best.